And I think, Peter, it's probably a safe statement to say that, when the market's at record highs, people's real risk tolerance, might not be accurate as when back in like the month of April when the market was falling, their real risk tolerance came out.
Well, while we are still holding steady in the markets, so to speak, back near all-time highs have been hovering around there. There have been a few days, weeks, months even this year that remind us that volatility is an ever-present factor. And as investors, something that we need to be aware of, maybe even worry about, but we'll talk about the approach to volatility today here on Your Game Plan for Retirement with Northwestern Ohio's resource for that common sense approach to planning for your financial retirement, your investment future. He is Chris McIntire, president of McIntire Retirement Services. And Chris, we always appreciate your thoughts, your perspective, and volatility in the market is something that is ever present, or at least the threat of it is ever present. So do we need to be in kind of a constant state of readiness for it?
Yeah, without a question. You don't need to squeeze your stress ball all the time, but I just happen to have one in my hand here for you that watch the podcast. Yeah, market volatility can happen at any time, right? Sometimes it can be somewhat predictable, like we coming into historically volatile months of September and October here, and that's when the market has its, it is often volatile. Okay, and you can make an argument one way that, well, boy, the market's at record highs. Are people going to sell off and take some profits and kind of see what happens? Or, is there an event that occurs geopolitically that, all of a sudden there's a rapid sell-off? So, and we like to say, look, healthy markets correct, and a correction is in that 10% range, but bubbles burst. So, it is normal for the market to go up, come back down, go back up. And if you look at the long-term trend of it, it goes up more than it goes down. It depends where you're at in your life cycle and, what you need to utilize the money for, how you position for that volatility, if that makes sense.
Is volatility when we are in the midst of it, Chris, something that we should react to with our investments? Or do we need to be prepared ahead of time, more proactive with our approach?
Yeah, so and that's why it's so important, Peter, to have your portfolio set around your risk tolerance. So if you're an ultra conservative type investor, yeah, you might not have anything in the stock market. You might use bonds and CDs and safe side of the annuity piece for your retirement. And then if you're, ultra aggressive, you might, just ride through it. Peter, you're younger than I am, so you probably ride through a lot of this. And, I know some of the trading you do, you even bet against the stock market from time to time, shorting it, we call that. But that's why you build diversified portfolios. And, for somebody who's a moderate, which is where most of our clients are, in that moderate to moderately conservative side, just because of the demographic that we typically deal with. So we might be 40 to 60 to 80% in bonds and other safe strategies like that, where the market, it's not nearly as volatile to the individual investor. But I will say most people look at the TV screen and they see all red, and then there's a big thing, market sell off flashing in red, so that you continue to watch it. And they all think that they're taking a bloodbath when they really look at their portfolio. Hey, the bond side didn't go down. I actually didn't lose. It wasn't nearly as volatile for me because your portfolio is situated around your risk tolerance. And that's a long-winded explanation to your question, Peter.
Well, volatility always part of the investment experience as we round home for the summer and hopefully temperatures begin to cool down a little bit. Let's hope that the market doesn't cool down, but how we are set up for volatility ahead of time, how we are prepared, and then how we react to it can dictate our financial outcome as well as our mental, emotional, and psychological financial well-being. So we want to talk about your approach to volatility here on your game plan for retirement today, ladies and gentlemen. And if you have questions or concerns about the potential for market volatility, the exposure that you have to risk, your tolerance, do the two match, feel free to pick up the phone, give Chris McIntire a call. These are conversations he loves to have and work through with his clients there at McIntire Retirement Services, a resource for so many proactive savers and investors across and throughout Northwestern Ohio, but so many more need that kind of resource, a professional, experienced advisor to help you navigate and guide you through the good and the bad times in investing and in the markets. And that's what your game plan for retirement, the document, the plan that you will get there at McIntire Retirement Services is all about. So to get that conversation started, just call 419-332-0532, 419-332-0532, 419-332-0532. Chris, as you are helping assess somebody's risk tolerance and risk exposure, that is part of the beginning and ongoing process. Is an analysis trying to drill down on their comfort level with taking risk and then comparing that with their portfolio. Can you describe the two sides of that and how often you see them matched or how off balance sometimes they are?
Yeah, absolutely. And you see a little bit of everything out there, of course, and somebody may come into the office and say, look, getting ready to retire here. So I've got my money in a 2025 lifestyle fund within my 401k. And then, we might go on to Morningstar or Yahoo Finance and put in that type of fund that they have, and then look at the breakdown. How much of it is in stocks? How much of it is in bonds, for example? And then, we'll do a comparison. Maybe we have a little program called Riskalyze, and that runs through kind of like Monte Carlo scenarios. How would you react if this happened? How would you react if that would happen? And then, that really helps to give you some of the perspective. And I think, Peter, it's probably a safe statement to say that, when the market's at record highs, people's real risk tolerance, might not be accurate as when back in like the month of April when the market was falling, their real risk tolerance came out. Okay. I mean, because you have a whole different emotional element when it's going down than you do when it's going up. And most people make, emotional decisions like you and I wearing light blue today.
It seems like though, Chris, we can only have one eye opened at a time when it comes to risk. And in other words, we sort of we focus on the conditions as they happen. When the market's heading down, we only see the downside of risk, the negatives, the drawbacks. When the market's going up, we're all enthusiastic, optimistic, and we only see the upside and the good part of risk. We kind of need to counterbalance, right? As we're seeing markets rise, we need to be cognizant of the potential of the downside. If we encounter a down period and markets fall, we always need to remember the potential growth that is there in the market. And a healthy balance is what's going to help us navigate those times, I think, more level-headed.
Yeah, without question there. You have to, that's why you do planning, right? We want to be proactive. The market can turn awfully quick there, when they called it Liberation Day. That's a pretty sharp drop in that 15 to 18% range, depending on which index you're measuring, and then all of a sudden it turned around and up we went, came right back and back at record highs in a short amount of time. So, it is hard to say, all right, I'm going to get out of cash. I'm going to go into cash until this blows over, right? Well, what day is that it blows over? When do you go back in? Because, we face these challenges all the time with clients that are adamant about getting out. Um, and it's like, okay, well, you call me when you want to get back in, because if you miss 10% on the upside, and that happens. That's just the way some people, get emotional about their nest egg. They don't want to lose a whole lot because they're retired. And, we all understand that. But that's why you put a plan in place. And that's why you have, safe strategies within your portfolio. So you don't have to dump the whole thing into cash, and you can weather the storm. You can let those dividends off of stocks and interest off of bonds buy new things at lower prices, right? That's what long-term investing is. Now, on the other side of that, if you're taking money out of your investment account, you really don't like to do that when the market's selling off, right? It's hard to recover. And that's why you have other alternatives in case plan A isn't working, you have a plan B in place. And, I mean, that's just prudent and in everybody's best interest to have more than just one set of directions, if you will, right? If I'm going to drive down to Peter's house, there's many different ways I can take to get there, depending on traffic, construction, and we could call that volatility, if you will.
And whenever I hear kind of blanket advice, Chris, I always like to sort of question, well, whose benefit is this really in? And I know that investors have benefited handsomely from the growth that is offered through the market, but we are taught to take risk. We are told to take risk. What are your thoughts on the balance there of whose benefit is that really in? I mean, it's got to be somewhat in investors' benefit and best interest to take risk. But I think that there comes a time when we continue to be told take risk, take risk, take risk, when really maybe that's more in the financial industry and Wall Street's best interest and maybe not the investors so much.
Yeah, yeah, that's a fair critique of the industry for sure, and it's well deserved in a lot of places as well. And we have independence. We don't have a corporate entity telling us what to do. So I think we have a strategic advantage to that. And
That's what
I
that
mean,
independent fiduciary perspective offers, right?
yeah, absolutely. And to compare to some popular TV commercials people may see where they say, well, do you offer products that pay commissions? And they say, no, we only charge a fee. It's like, all right, so you don't offer life insurance, you don't offer long-term care insurance, I mean, those things pay commissions. You don't offer an annuity to somebody whose number one risk is running out of money. And yep, those things pay commissions in a lot of shapes. But think of it this way, okay? If an annuity pays or a life insurance policy pays a 6 or 7% commission, okay, uh, and the person owns that policy for 10 years and they got paid a commission from the insurance company, not from the client's assets, versus charging them 1% on their full portfolio every year for 10 years. Which one costs the clients less money?
Well, and by the way, the commission paid by the company not coming out of the client's pocket or account, whereas money in the market, take risk, take risk, take risk, right? That approach. And here's where I say, hey, is that in the financial industry's interest more? And there's a time and a place for both, but that money does come out of the client's accounts or balance. So yeah, I've
Yep.
seen those commercials as well, and there's a lot of kind of intentional double speak there, Chris. They're like they try to create this false sense of distinction where at other firms they charge you whether your account goes up or down, but at our firm we do better when you do better. And they're trying to act like that's a different statement when in fact that's one and the same. If the account goes up, the fee is going to be based on that account balance. So they make money whether the account goes up or down on either side of that statement, but they're trying to make it sound like it's something different. And those commercials have always sort of irked me when I hear them as well. I know the ones you're talking
Yep.
about.
Yep, absolutely. Yep, we kind of call that like a cult-like mentality sometimes over there. But anyway,
False
well,
advertising, essentially.
yep,
And if they're
yep,
kind of being less than completely truthful,
yep.
to get you in the door. What happens once you're in the door and they have your money is kind of a question I've always asked. Anyway, that's again a reason why an independent fiduciary advisor talking to an experienced qualified professional, ladies and gentlemen, getting a real plan in place rather than kind of a stock portfolio that basically everyone gets the same portfolio is probably in your individual best interest. A personalized approach, goal oriented to your goals with long term vision and diversified strategies. That's what's included in that game plan for retirement. If you'd like to have that conversation, hear for yourself what kind of difference that makes and some of the conversations that are not had at many other financial institutions about protection, about income planning, about tax management, about legacy planning, all of the things that we talk about each and every week here on the program, give Chris McIntire a call, get your your game plan for retirement put together. 419-332-0532. 419-332-0532. So, Chris, we're told we should take risk. However, is there any rule of thumb or guideline that tells us how much risk we should be taking with our money and investments?
Yeah, there are certainly rules of thumb, and our dear friend Dave Gaylor used to go through and say, if you take 100 minus your age, that gives you basically what you might want to consider to have in the equity market. So 100 minus 60, so 40%. And then you have to gauge in. All right, well, does this person have a pension and Social Security? And did everybody in their family live to be 110? Then you start changing some of those parameters, obviously, because it can't be one size fits all. And that's where software and that risk-alize, some Monte Carlo scenarios kind of help people understand what it is. Because believe it or not, Peter, as some folks have never really paid much attention to the investment landscape. They just put as much money as they possibly can to make that number bigger and then hope that that carries them through retirement. And, our job is to, analyze all of that, come up with the right, programs and investment portfolios and whatnot to help them achieve those goals and dreams.
Now, Chris, I know that you're a fan of success when it comes to investing, and part of the formula is invest as much as possible, as early and often as possible, kind of whenever possible. We are the gasoline in the engine for long-term investment success. The market does part of the work keeping the momentum going, but we've got to build that momentum. But I know that you're also a fan of balance, and that, hey, we can't take it with us and live life a little bit along the way too. Having the plan is what is going to allow us to have that balance, to know that we're doing the good things, the fun things today, living life a little bit, but also all of the right things so that we can continue to live life in the decades in front of us.
Yes, absolutely. And it's refreshing to sit with people and tell them, say, look, here's, walking through all of their, possibilities they have for investments and whatnot, and forecasting and using our software programs, helping them choose when's the best time to take the Social Security, their filing strategies, assisting them on the estate planning side to, help plug some of the holes in their bucket, if you will. We all have holes in our bucket, no question about it. But if you're going into, example, you're going into retirement, you don't have a will, you don't have a power of attorney, for finance and healthcare and some of those things. I mean, that's a hole. You need to plug that hole. And if if you're coming into retirement through a second marriage where you both have assets and children from previous marriages, those are some special considerations. So, it certainly is not a one size fits all. Everybody has different sets of circumstances. My wife and I don't have children. Peter, you have one child, and he's going to be a Major League Baseball pitcher, so you probably don't have anything to worry about there. But
We'll see. We'll see.
yeah, so
Um,
you and I, yeah, we have different estate planning pieces. You need to, you're at a different phase in life, so things evolve over time. And I tell a lot of folks that come in that are getting ready to retire, it's like, look, you're going to look at things here a little differently because right now you're retiring and you need to take care of yourself. Okay, as you go through retirement and you're done with all your worldly travels and whatnot, and health considerations come up. Okay, then you may be more concerned about, all right, how do I get rid of some of this stuff in case I go into the nursing home? So there is a transition into retirement. It's not like I retired at 65 and I don't have to ever change or do anything any different because I'm retired. That's not the case.
No, our needs change and evolve. And that happens over time, but it can happen quickly as well. And that's, I think, why we need a plan in place. And certainly the world changes over time, but certain things, events can change conditions quickly also. That's where the plan is going to help you navigate those changes, ladies and gentlemen. We come back to it time and time again on this program, but Access to the market is important, but it does not constitute a plan. A 401k or an IRA is a fantastic tool, but it is not a blueprint. It does not lay the foundation for ongoing stability and to build your financial picture, the walls, the ceilings, all of the features, the way that you want them. That is where the plan comes into place, and there are critical pillars in planning that most people have done well. Income during their working career, investing. Most of the people that you talk to, Chris, and that would listen to a program like this have probably done well in those two areas. But then we end up arranging our affairs that sort of work against us in several of the other critical pillars. Taxes in retirement. We set ourselves up to pay more than we need to, which affects the cost of health care. Some of us don't have a well thought out plan for claiming Social Security or how we're going to tackle those healthcare costs. Leaving and creating that legacy, tax deferred assets, maybe not the best legacy to leave behind. And those conversations often aren't had, and critical aspects overlooked. And we believe, ladies and gentlemen, that you should have a plan that addresses those for lasting financial confidence. That is what your game plan for retirement is all about. So give McIntire Retirement Services a call, 419-332-0532. Complete that plan. Round out all of those edges. Get all of the pillars in place for good stability and structure of the foundation and support, but the pillars support the growth and the roof as well. So 419-332-0532. 419-332-0532. Chris, I actually want to circle back to quantifying risk and how much risk we should take, because we've heard of this asset allocation model, and I think that you were touching on it, but I want to clarify there with that rule of 100 that says you take your age and subtract it from 100, and that's how much you should have in the equities market. When we've heard the old asset allocation kind of modern portfolio theory of the 50-50 or the 60-40 portfolio, is that the part that is at risk and then the rest of the money should be absolutely safe? Or is that the division of the assets and the percentages that should be on each side, the fixed income and bonds or the stocks and the equities market? Does that make sense? Like, should 50% of our money be absolutely safe and then 50% of our money be divvied up 50-50? Or is the 50-50 the division there?
Well, that's a tough question to answer there, Peter. And I'm going to hold up the book from our buddy David Gaylor here, who passed away on us. But he talks about income allocation, because a lot of times, when people are retired, they're looking more for income than they are asset allocation. What do I do? Asset allocation is a pretty generic form, I think, right there. So, our specialty is to say, look, let's really look at how we want to define what asset allocation is. Are we allocating assets for growth? Are we allocating assets for income? Are we allocating assets for safety? And if we're looking at safety, are we talking about a money market account? Are we talking about an annuity, a CD, or a bond? Or when it comes to assets for growth, there we're looking more at stocks and bond and mutual funds and ETFs, exchange traded funds. So again, we got to break this down here. And how does the client I'm looking at, how do they define asset allocation, right? Because we think, you and I talk in this Wall Street language all the time. The rest of the world doesn't always talk into that. They don't know what an ETF is and a PE ratio and, what's the smart, what's beta, what's alpha. You have really got to, simplify some of this and talk in ordinary terms. And I think that's something that we do very well, Peter.
Well, I appreciate you hearkening back to the income allocation. And I think that answered my question perfectly, right? Is that we have to designate a portion of our portfolio to generate the income that we need. That is going to allow us the comfort in taking the risk on the other side of our portfolio. Because if we're generating income from equities and then the market goes down, all of a sudden, Chris, we get a little tight. We get a little nervous. It affects our mentality, our willingness to spend, our enjoyment day to day, and it can greatly affect the trajectory of the portfolio growth if we're pulling money out to create income in a down market. We've called that sequence of returns risk, and I think that's a term that we may talk about more specifically in a show to come. Maybe we'll do a little review back to school on some of these terms here, but sequence of returns, something people absolutely need to know and understand. But the balance there, Chris, once we're in retirement, is part of our portfolio needs to be responsible for generating income. And then we also still need some growth money. So I appreciate the answer there again. And I know that you really work hard in helping people define what that ratio should be. And that's why it's a hard question to answer. Probably a little different for everyone what the breakdown of those two sides and that balance is, correct?
Yeah, absolutely. And when you're seeing NVIDIA and the tech sector, which is, so heavily skewing the performance of the S&P 500, people can get, out of whack with, hey, should we be putting more money in AI and cryptocurrencies? We're getting more and more of those phone calls, and obviously cryptocurrencies are, some probably the talk of the town, especially under this administration that is very pro crypto. But it's also can be very volatile as well. And it's like if you were in it a long time ago, they've done incredibly well. But boy, it can that can also turn very quickly. So how we allocate these assets on the growth side of things these days is becoming is expanding ever. Private credit, for an example, where kind of the private banking system. You can invest in private equity firms. There's a lot more opportunities for growth out there than, picking a hot stock or two.
Well, I definitely hear you and have enjoyed the rise in the market due to some of the AI and technology. However, I've also seen reports that like the ancillary industries are not there or keeping up to continue to support that. The semiconductors, the chip makers, the energy, just not there in the infrastructure. So is that another bubble that harkens back to the dot-com bubble? We don't know, yet to be seen, but that's why we need to understand our risk exposure, have documented how comfortable we are with it, make sure that it matches and aligns with our portfolio, and have a sound approach not only to volatility but to safety as well. And Chris, there's a time and a place, a rhyme and a reason for taking risk, also a time and a place and a rhyme and a reason for safety. Safety of principal, protection of principal, and safety and protection of an income stream that we can rely on in retirement. And that balance is found through a detailed analysis, more than just, hey, we're returning 10 or 12% in mutual funds. That doesn't really help somebody arrive at a conclusion for their situation, right?
Yeah, absolutely. And things happen awful quickly out there these days. As we look at the way the markets perform, what we have going into the kind of the holiday season here, where things can get volatile is, an exception to that could be some significant interest rate cuts coming from the Federal Reserve into the third and the fourth quarter. That would be bullish for stocks, bullish for bonds, especially dividend paying stocks and things like that. Those can do very well. The small cap companies have been, lagging behind significantly. So interest rates cut obviously help small businesses that, probably have higher borrowing costs than a big company would have. So, it's going to be a very interesting dynamic as we close out the rest of 2025 and then, looking into 2026 with, continued, investment in the United States as, some of these tariff or, trade negotiations and all of that appear to be a little more favorable here to the U.S. than maybe what we previously had to try to stay neutral on the political side of things here. But, things you would think would be looking brighter over the long haul. And remember, we invest over the long term. We don't invest for 6 months.
Yeah.
6 months is not a very long time frame to gauge how your investments are performing.
Well, there is things have worked out certainly better than the initial reaction in the market after Liberation Day sort of indicated, or what was thought to play out there. And markets have bounced back. We've enjoyed that. We've appreciated that. But things in the market are volatile, ladies and gentlemen. That is an ever-present factor that we need to be aware of, even when times are good. Maybe that's when we need to be most aware of the potential for volatility. No one wants to suffer market losses, but no one can accurately time or predict when and where the market is going to turn. And unfortunately, losses and volatility part of the investment experience. But considering protection does not mean that you have to give up on gains either. So having that plan, striking that balance, essential for your financial well-being, as well as your enjoyment of life, the mental, emotional, psychological well-being, because a lot of that is contingent, depends on our money as well. Having a plan in place is what's going to allow you to feel that confidence, regardless of what market conditions may bring. And Chris, we always appreciate your perspective on how people need to be thinking about their money, dealing with their investments, and the potential, whether it's here or maybe just a threat in the future, that volatility could be here or could be around the corner at any time, and be prepared for that. So again, we appreciate the time, Chris. Ladies and gentlemen, for you, if you would like to get that plan put together, it is your game plan for retirement, a personalized plan for you covering income, investments, taxes, healthcare, legacy, Social Security, protections for long-term care. All of that is your game plan for retirement that you can get put together for you, personalized at McIntire Retirement Services, and only there at McIntire Retirement Services with your game plan for retirement. So pick up the phone and give a call, 419-332-0532, 419-332-0532. You can also go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, again, always appreciate the time. We thank you for being here.
Hey, my pleasure. Thanks for listening, everybody. Be safe. God bless America.
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.